All right. Well, good morning, good afternoon, good evening, wherever you may be in the world. Thanks so much for joining us. Today's discussion is about how startup founders can optimize the startup equity for the co-founders and for the employees. And we've got a terrific panel of experts here to join us. So let me introduce them one at a time and bring them up. Louis, good morning. Where are you?
Good morning, everybody. Dialing in from the Silicon Valley, about a half a mile south from Stanford University. It's always great to be with you, my friend.
Very nice. And let's bring Andre on as well. Andre, where are you calling in from today?
Hey, Brad. Same place. Actually, it's a few doors down from Louis from our Palo Alto office here on Page Mill.
All right. Did you bring Louis any coffee this morning?
I did not. It was his
Yeah,
turn. Actually.
it's his turn. And also with us is Ben. Good morning, Ben.
Good morning.
So,
I am coming in from San Francisco. I'm in South Park in a friend's venture office.
South Park in San Francisco, California.
It's the
Very
Sand
nice.
Hill Road of San Francisco.
The Sand Hill Road of San Francisco. That is exactly right. So, so guys, let's. I guess to start with, I'd like to ask each of you to just kind of briefly introduce yourselves and a little bit about your background. Ben, you want to start?
Sure. I'm Ben Narrison. I was an entrepreneur for 25 years. Started one of the first e-commerce companies in the world in 1993. Took that public in 99. Never raised venture capital, so had enough control to take it private. So that all came to a close when the bubble burst around 2001. Moved west, got to Silicon Valley about 18 years ago. Saw a gap in the market between angel and venture, which I decided would be exciting to pursue. So I started what was at the time one of the first institutional seed funds in around 2007. So we're now 15 years into the seed trend. Very exciting. Relevant to this conversation, though, I do want to make a couple points here. One, I spent 8 years running a seed practice for a large venture debt shop. They cared as much about my network as they cared about my investments. And I cared a lot about who my entrepreneurs had as board members because I had a very painful board as a public company CEO. So I got to know well over 300 VCs, and I made a real study of how they thought, what they did, what they wanted. So a lot of times when I talk to my entrepreneurs about venture, I'm talking about all those things I learned from those people that I got to know over that time. Lunches, dinners, breakfast, shooting, whatever. And I was a journalist for a long time, and I learned you can ask people really hard questions. They usually will answer them. Unless they're bankers. Bankers never answer any questions. Those need somebody on the line to tell them no. And then, so anyway, net, after 8 years as a seed guy, I became a traditional VC. I was a general partner of a small fund for a while. Then I became a full-time investor at NEA, which to me is the best firm in the world. Awesome group of people. Was there for about 4.5 years, but then was backed by them to spin out and start a freestanding seed fund, which is called Tenacity Venture Capital. If you want to learn about us, you can go to LinkedIn because we don't have a website, but you can see 30 testimonials from our entrepreneurs saying why Ben and Tenacity and Taylor are somebody you should work with. So net, we do everything before the Series A. We do pre-seed and seed. We write $1 to $3 million checks. We've got a $60 million-ish fund, which was raised really quickly. I'm having a lot of fun. I love being back in seed. Seed to me is the most fun. It's also the hardest and grittiest and most dangerous time because there's a lot of mortality happens, and it's interesting, and I'm dealing with that right now. But be happy to be here talking about how I think about how entrepreneurs should protect their equity because that's super important, and it can mess up future rounds if you don't, and on and on and on.
Awesome. Thanks Ben.
For having me. Thanks for Louis for inviting me.
Thanks again for being here. Andre, tell us about you and why you're here.
Hey, Brad, and great to be part of this panel. Yeah, so I'm a partner here at Foley & Lardner. I focus my practice on emerging growth and venture capital. Also have a background on M&A and private equity as well. I have a little bit of a different background than your traditional, I think, Silicon Valley lawyer. So I practice, I have Brazilian parents, so I was a Brazilian lawyer for about 10 years before coming back to the US and doing this for another 10 years. So I've been doing it in multiple jurisdictions for about 20 years now. And have joined this great team here at Foley back in mid last year. And we do from very early stage, which I think is what we're going to talk about, until we go companies that go public. We joke around that we do a garage to global type of approach, providing a full services to our clients. So it's very, very excited to talk about this particular topic, which is something that we as lawyers advise our clients and counsel them on a day-to-day, either when they're getting questions from or preparing to talk to people like Ben, for example. We try to prep them as much as we can. So that's a little bit of me.
Awesome. And last but not least, Louis Lowe.
No introductions needed, Brett. I am delighted to be here. Like my friends here, I serve at the pleasure of this amazing global Silicon Valley community of founders, and we have a great program here today to talk to you about how to get it right from the start and what to do if it goes wrong. Brett, you and I did this panel a year ago, and things have changed quite a bit. And I'd love to hear from your perspective where things have changed, and maybe we start from there. How to get it right from the start, and what happens when things fall apart.
Yeah. Well, so I was thinking about this morning, Louis, and I was thinking about how most startup founders want to raise some outside money. They know that means giving up some equity in the company, but they also want to keep control and keep as much equity as possible. And so that's kind of the heart of, I think, this discussion is how do entrepreneurs balance those two things, right? How do they both sell some equity as they scale the company while also kind of optimizing the outcomes for the co-founders and for the employees? And as you kind of alluded to, Louis, we sit here, as we start the second quarter of 2022, we sit kind of in an interesting spot that the fourth quarter of 2021 was probably the best time ever to be an entrepreneur raising money. That the
Best ever.
Entrepreneur had all the power in the world in the fourth quarter of 2021. And in the first quarter of this year, that looks like it started to change a little bit. The public markets are off. There's concern that that's going to affect the private markets. And as we begin here in the second quarter of 2022, I think kind of in everybody's mind is, where are we exactly right now in terms of the kind of the power dynamic between investors and entrepreneurs? So I think it's an especially opportune time to have this conversation.
Well, I agree with you, Brett. I think that the winds are in the process of changing, and whereas in December, I was asked how far I could push the envelope. Today, I'm thinking a little bit more clairvoyantly that instead of how far can we push the envelope, where is the right place to land? And when you work with great investors like Ben, you really see how they think about looking at an investment opportunity. And I think the first thing that they look at is who is the team. And then the second thing that they look at is the team, locked in. And Ben, I'd love to hear from you as to what you look at when you see a team of founders in an early stage opportunity that comes across your desk.
Yeah, I think it's all about the team. And in fact, the reason my firm is named Tenacity is I believe tenacity is the only secret to entrepreneurial success. And I say that based on the fact that I only fund companies where I believe there are phenomenally brilliant entrepreneurs with a huge opportunity and a great idea. So given smarts, great idea, big opportunity, the difference between success and failure often comes down to whether or not an entrepreneur is willing to give up. Being an entrepreneur, I will often say, is the hardest job if you're not a first responder risking your life. It's certainly the hardest job that can happen inside an office wall. And it's far harder than people realize until they're actually doing it. And so, when you wake up every morning, you get hit in the face with a virtual sledgehammer, that gets very, very, it brings people down, and not everybody makes it through. So I'm constantly trying to find ways to detect the, I will not fail, I will not give up vibe. It's funny, my partner Taylor and I were down in Costa Rica with an LP, and we were playing pickleball. And, it's like, I'm okay, I'm not good. The guy crushed me. And Taylor was really good, and he also beat him. And Taylor's like, I hate to lose more than I like to win. And I realized that is the perfect statement of my entire life. Like if I play poker and I win a couple $100, I will forget it in a night. If I lose $100, I'll remember it for weeks and it'll bug me. And so that's part of it's like the type of just that drive where it's like losing is so painful to you personally that you're not willing to let it happen. I've got a company right now that had a $5 million term sheet, and then the guy that gave it to him had a heart attack. So that term sheet is gone. So all of a sudden, a very consistent, nice, easy plan turns into emergency action, 6 weeks of cat, cut burn, like everything. He sent me this 10-point plan. He's really on top of it. Cut his own salary in half, et cetera, et cetera. So I do need brilliance because just raw brain power, cycles are important in this business. But I'm as obsessed with brilliant people that are tenacious. Brilliant and lazy doesn't work. Brilliant and lucky, forget it. I mean, net, we all have to be lucky. Without luck, none of us do anything effectively as entrepreneurs. But the harder you work, the luckier you get. And so, it's just. And lastly, I think it's sort of one thing I don't care about is sort of what your historic profile is. I don't care where you grew up, don't care where you went to school, don't care what you did, unless what you did is illustrative of your ability to do this new thing that you're doing. So we were just talking to a team in Latin America where one of the people has a deep set of experience in, call it the SMB credit space. So that gives them an insight into doing things for credit in LATAM. But I do not need to, I'll take the top 1% out of Santa Barbara City College over the bottom quartile at Stanford. It doesn't matter to me that you have a fancy degree. Right. What matters to me that you have what in you, what I need to see to get you to drive through. In fact, I have a lot of entrepreneurs out of Stanford, by the way. I love Stanford. It's great. It's nearby. I go over there all the time and do like deck doctors, and I funded a lot of founders. But I'll tell you, the single worst founder I ever saw was like summa cum laude out of Stanford, because he thought the world owed him something because of his great achievement as in his education. Yeah. But yet what he had managed to do was prove that he could fail repeatedly and run a horrible business that made no sense to anybody. And yet he just kept coming back to sort of look at me. I've got this great degree. You should really care. Right. Well, it's a signal, but sorry, everything else about you is no good.
All right, we're going to come back to you, Ben. As I look at sorry, go ahead, Brett.
Oh, I was just going to switch the conversation over to Andre, who hasn't had a chance to speak yet. Is that okay with you, Louis?
Yeah, Andre.
All right. So, Andre, the topic of optimizing equity. If a new entrepreneur comes to you as a client and says, "I've got a startup, I want to raise some outside money. I'm going to, turn this into a rocket ship." What advice would you give them with regard to optimizing founder equity?
Well, I think the first things, especially for a first-time founder, is explaining how the process works, right? It's telling them that this is a long game that's going to be typically serious, several rounds of financing. So what sometimes you see is founders are very eager to hire people, and in order to hire people with very little cash, they have to give equity. And so managing their cap table at an early stage is very, very important to them, because it would allow them to avoid discussions about having to do recaps or discussions with the investors later on in the game when they actually start having very little equity in the company that they founded. So a lot of it is letting them learn to listen, this is going to take a while. You're going to get X% out of your company on your early stage financings. Then it's going to be another 10 or 15 on your A. And then as your company grows, you're going to lose more and more and more and more. So be very, very careful as how you're hiring people, and you're using that equity to incentivize them how much of your company that you're losing at that stage. The other thing that I think a lot of first-time entrepreneurs make as a mistake as well is, and that happens quite a lot, and I think more often than people think, is whenever they're doing their very early stage convertible notes or safes, they tend to miscalculate how much of their company they're partitioning and giving it up. So we have more often than not, especially first-time founders that come in and say, "Oh, I did these safes. I own currently Lehot. If I do an equity round of X with new money of Y, I own 50% of the company." And when you actually go to do the math, you say, "Well, sorry, you actually own 35 or 30% of your company because of how these convertible instruments work." So a lot of it is explaining to them and try to educate them as to how to go about it, what the market practice is, and where they should be in terms of managing their cap table at that stage of their company. Now, when you talk with more savvy founders that have been through this round several times, right, then I guess the question to that founder is, okay, this is what you did in your prior company. This is what did work out, did not work out, right, and how we can manage that moving forward, especially where your end goal is, Brad. Because I think a lot of founders, they realize early on, it will be interesting to hear the panel's opinion on this, is that sometimes the founder has an idea that he or she knows it's the one that they're going to be like the new Google or Facebook. And sometimes they know very early on, it's going to be a very mature company. It's going to be a very healthy company, but I may not hit out of the park on this one. So I need to be able to manage that as they go through their fundraising process as well.
So I just want to jump in here and say that, so Andre mentioned cap tables. most of our audience probably knows that's capitalization table, which is just simply a list of everybody who owns stock in the company or has been promised stock in the company. And I know from personal experience that one of the mistakes that founders often make that leads to unexpected dilution is, you make promises, you're assembling the team and you're promising this, that, and the other thing, and you're promising stock options or promising equity, and then you forget to enter it on the cap table. And that can be a very painful experience down the road.
Ever happened to you before, Brett?
Yes, it has. In fact, I wrote a blog post about this. Cost me 130 grand out of my pocket. And so kind of that's, part of what Andre is saying is, be mindful of the cap table. And the good news is that today there are tools like Carta out there that make it really easy to manage your cap table, and also very easy to kind of model different cap table scenarios. So as Andre said, sometimes people are handing out safes right and left, and not quite modeling how that's going to net out once all those safes convert to equity. Ben would like to jump in, and then Louis.
Well, just that also remember that if your early investors have pro rata rights, that will pile upon it.
Excellent point.
So,
this is a good segue. I'm going to stop you, Ben, just to segue into Louis for a minute about pro rata rights. And so often, I know, Louis, that you these days, you're doing a lot of safes that have side letters, right? And so tell us a little bit about what is a side letter and what are the things that are in that side letter that, as Ben said, may end up in increased dilution later that you should be aware of.
Sure. So the safe has become the ubiquitous form of early stage, or what I'll call seed financing, until you meet an investor like Ben, who's going to want to put a price on the company and make a long-term investment. And a safe is a simple agreement for future equity, as we all know. And investors increasingly are asking for a safe side letter that preserves their pro rata rights, and sometimes even their super pro rata rights, to not only invest in the next round, but to invest in all rounds at levels at or above where they're at, which
so Louis, I'm just going to say, give us the quick definition of pro rata rights, and I think you were actually going into that, but
Sure. So a pro rata right is the right to continue to invest to maintain a certain percentage of your company, pro rata. So if you own if you're buying a 10% stake, a pro rata right is the ability to invest at future rounds to continue to be at 10%. Super pro rata rights is the ability to go up to an even higher level. And some savvy investors, in order to maintain a position in a company and to give a certain valuation, are asking for super pro rata rights, in addition to a whole lot of other things, some of which are healthy and some of which may not be.
And if they exercise those rights, that ends up diluting the founders.
Exactly.
Yeah.
I want to go back to the beginning, Brett, and talk about that process of how to set your equity right from the start. And I think the first thing you need to do is define who is the founder team, because that's who's going to get the vast majority of the common stock at inception. And then you're probably going to reserve, so that's probably 80% of the common, and then you're probably going to reserve maybe 20% of the common for some sort of an equity pool. And you really need to look at who's going to do what are the roles and responsibilities. Is this person on the team somebody who's a short-term player, a long-term player? And you really want to be forming a team that really is a long-term player. The person you want to put in front of Ben, the person whose value is going to transcend every stage of the company. Of course, things always change, but that should be your vision from the start. And anybody who's a temporary player should be a consultant, an advisor, get options. And then the next thing we're going to talk about is vesting. Founders are going to need to vest into their equity over time. And an investor like Ben is going to expect that they're going to vest for 4 years with a 1-year cliff, so that if they leave within that first year, they get nothing. And the idea there is that there's so much value created in that first year that if you leave, you can't walk away with anything, because it could be fatal to the company, and the contribution really that you've made hasn't crystallized. Ben?
I'm not as harsh on this as you've probably seen from some of the deals I've negotiated, in the following way. So, what usually happens is two guys or gals, or guys and gals, start a company. and they each own 50%, let's say. Then they bring in some founding members and they give them a percentage. So they walk in to fundraise and they've got 50% each. Now they've been doing it for a while because I tend to do seed more than I do pre-seed. So they might be a year in, they might have real revenue. Now I still remember when I had a company which I took public, the first time any investor told me like I had to revest my shares, I'm like, the hell are you talking about, man? These are my shares. I started this company. This is my company. You're putting money in. So I have a lot of empathy for entrepreneurs on this. Now, having said that, here's what I will usually say to an entrepreneur. Okay, yes, the standard is 4-year vest, 1-year clip, blah, blah, blah. But, not to negotiate against myself in advance for whoever watching this that comes to pitch me a deal, I'll usually let them keep 25% of the shares straight up, and then the remaining can be vested over 3 years. And I'd like a 1-year clip, but I'm not sure I care a lot. And my pitch to them is, first of all, it's more than fair. It's not, as you said, plain vanilla is 4 years with a 1-year clip. But here's the thing, like when you go to do your Series A, if you haven't done this revesting, they're going to make you do it, which means you're starting over from zero. You could end up with a 4-year vest, 1-year clip at your Series A, having been running your business for 2 or 3 years, which personally I've never liked as an entrepreneur.
Ben, this is an important point, though, because what you're saying is founders are going to vest over 4 years at formation, and then you're going to make them revest again when you put money in for at least 3 years. And if there's been more than a year between formation and the financing, we've got to think about vesting again. And that in itself is a critical point to think about vesting. You want to make sure that when you set up your equity from the start, you can demonstrate to an investor like Ben how long you've been in it and that you've been earning into your equity.
Now, I might not be geeking out enough on the docs, but I think I've not seen a lot of entrepreneurs place vesting upon themselves. I think they just get the shares in the beginning and then they're having that negotiation with whoever the newest investor is. But I'll make one last point. The reason that, as Louis knows, I very much want you to do an equity round for a lot of reasons. I think safes are at best training wheels. They're basically for lazy investors that don't want to have the hard conversations. They're just delaying all the work. I think they're a little bit of amateur hour, to be honest. You don't want to play the big boy game? Well, fine. We'll just give you some training wheels and a big helmet and a puffy suit. You good with that? So you're going to have to negotiate all this stuff eventually. So I make 2 pitches to entrepreneurs I think are relevant to this conversation. One, do it now. You will never have more time available to deal with this, right? It's not like when your Series A comes around, you magically have developed an extra 8 hours a day to spend on BS. Secondly, and this also goes to the vesting, as long as you've got an honorable, entrepreneur-friendly, hopefully ex-entrepreneur seed investor, which is the way I think of myself, you're probably going to get far better treatment than you are from the Series A guy or gal. And so my pitch is, look, if you and I do it in a fair band, it'll probably hold up. In other words, if you revest and I let you keep 25% plus vest 25% a year over the next 3 years, or net 25% over 4 years by you the first year for free, you'll have 50% of the company by the time you raise your Series A. When the people in the Series A look back and they saw the process, I think there's a reasonable chance, Lou, you can push back, you think I'm wrong. They're going to say, that seems okay. We'll let that stand. Now, if I let you keep it all, they're going to be like, no way, revest. And if I was really an ogre, which is also the reason, by the way, you have to be careful about how much equity you give up. Venture investors actually care that the owners of these companies, that these entrepreneurs have enough. Yes. Because if they don't, they worry a lot. I've had to fix things before, both as a seed investor and as a Series A, B, and C investor, where I felt the early investors were too piggish, took too much for the entrepreneurs, and I had to go in and say, I'm not doing this deal unless we re-up you. We need these old investors to give up some of those shares so the entrepreneur has enough skin in the game, or I can't have confidence because I'm not going to be the one that takes the heat from these self-inflicted wounds later when you whine to me, as people often, I'm not motivated anymore. I own so little of my own company. You took the money.
A couple of lightning questions for you, Ben. How do you feel about Class F founder stock or any super voting founder stock?
I don't think it's come up in any of my deals, and I've done 126. So I think it's much rarer than people believe. Actually, not true. I think Parker had Class F in Zenefits, and I assume he has it in Rippling. I invested in both. But here's the thing, and this is all public data, right? So I'm not spilling any beans here. Here's an entrepreneur that got Facebook quality shares and still got fired. Okay, so it's great for you to believe you have all this wonderful protections, but good luck with that. Documents are useful pretty much only on the day after 3 years of fighting you end up in court. If you don't have a trusted relationship with the party across the table from you, that document doesn't mean shit. Okay. Yeah. I just literally got off a call from a founder in London who had a family trauma. He left for a month and a half, and his co-founders kicked him out. Everything just disappeared. His access to the bank account, his access to emails, and he's asking me, like, what should I do? I'm like, I'm not a litigious person. I would just go on with your life and start another company. But like, this guy he feels he's been severely wronged. At the point that he sues and that it gets to court, those documents will matter. And that'll be multiple years and many, many, many dollars and just a painful process. So focus on the relationship, focus on the quality of people, focus on having people that you want at your side for 10 years. Because, some people get trained, investors are like dumb money to be squeezed for every penny, but those investors have rights. And if they're going to stick around and be on your board, then, this is a marriage and it lasts longer for successful companies than the average American marriage.
So I think Louis and Ben make a really good point, which is, so new entrepreneurs often ask me, how do I make sure that a VC doesn't, take advantage of me, because all they want to do, they just want to control the company. I've heard about this. They want to have enough that they take over. That's what they want. I try to just dispel that myth, because VCs do not want to run companies. They want the opposite of that. The entire reason why they're venture capitalists is that they don't want to run companies. They have no desire to take over your company. And as Louis said, they want the founding team to have enough equity that they are super, super incented to make this thing a success. So if anything, not only have I not seen investors try to take over a company, I've several times seen investors recapitalize a company in order to give the founders more equity because they've been squished down so far. And that's a really important thing.
One other point on the vesting, which tends to be, it happens in fewer cases, but it does happen. And sometimes the vesting also from the early stage, as Ben mentioned, and putting investing, and that's something you have to explain to Ben's point as to why am I putting this, I don't own 100% of my company from day one. The other thing that people don't think of at times is that sometimes people change their minds. So you can have a company that has 3 founders, and one of the founders say, listen, you know what? I don't like this idea. I got an offer from Facebook and Google. And then all of a sudden, if there is no vesting, that person owns a third of the company. If you did 33, without doing anything, it's going to capture the value. So when you're doing the recap, when investors are coming in and have the actual founders that are working in the business with the skin in the game, you all of a sudden lost, in my example, a third of the company for someone else that's doing nothing for the company at that point. So sometimes we all think about companies that go, oh, everything is going well, everything, the company's right. But there are cases that people change their minds. They want to do something else. And as a general good corporate governance practice, you want to protect your cap table of the company, even for you as a founder and for your investors as well, because then you want to avoid to have those tough conversations about recaps at your A financing, your B financing, or whatever is the stage of your company.
Right. I can't tell you the number of times I've seen a cap table, and I'm like, who's this guy that owns 20% of the company? And he's like, well, he's a co-founder who left after the first week, but he's still there on the cap table. He still owns a big chunk of the company. So the way to solve that, as all of our panelists have said, is to put everybody on a vesting schedule, including the co-founders. Louis, you want to add on to that?
I think it's a great segue, Brett. So we've talked a lot in this first half an hour of our segment here today about how do you set things up right from the start. And I think we've established a baseline that you're going to have a cap table. Only founders should get equity. There's going to be some vesting. You should have an equity plan with options, also with vesting for people that are going to be, temporary players or in non-founder roles. And now I think we ought to talk about what happens when things change. And I think things can change in a lot of different ways. You can have somebody who all of a sudden has a new family and needs a salary and benefits and or is just unable to put in the time that's required. Perhaps the critical mission of the one of the founders who maybe is an evangelist is no longer needed because the company's been evangelized, and really what's needed is somebody to grow sales and marketing, and maybe that evangelist really doesn't have a seat at the table. And so how do you deal with that? And I think it could also be a breakup. We saw at the outset of the pandemic, just like we saw in people's personal lives, in their companies, there was often these fantastic fireworks, which led to founder breakups. And so I would love to hear from you, Brett, as to kind of how you think about evolving founder roles in companies.
Well, I think you said it perfectly, Louis, which is just that things change. There's the great John Lennon line that life is what happens while you're making other plans. Uh, right? And so,
Way to bring music into this.
we'll bring tacos in later, Louis. So, the three co-founders, they sit around a table, they're all excited about their startup. They decide who's going to do what. They decide what the fair equity distribution is amongst the three of them, and they go off to conquer the world. And inevitably things change along the way. As you said, the co-founders have life events, or their roles and their responsibilities look like they should change, and so you want to be able to have some flexibility around that. And that's actually kind of a good segue into a question that we have from Alex, which is more about recapitalization. So I'm going to give I'll give my layperson's answer to that, and then I'll let the attorneys jump in. So recapitalization, so I mentioned before, cap table is just a list of everybody who owns stock in the company and how much they own. And with shareholder approval of everybody, you can kind of remake that and say, you know what, we should change some of this stuff. And that's what a recapitalization is. Louis and Andre, you want to correct me now with the more strict legal answer?
Well, I think a recapitalization can be as simple as this. Here's the cap table before the event, and maybe we have 10 holders with different percentages that are not equal, and then after the transaction, everything's changed, and people didn't necessarily buy or sell shares from each other.
Yeah.
There was just a rebalancing.
Right.
And now the tax rules may tell us that there was a redemption or whatever. And I'm certainly not giving tax advice on this webinar, but it's really that simple. It's before and after, and everything changed.
And typically this requires approval of all the shareholders. Correct?
Oh yeah, approval from the board, the stockholders, and if you do it right, really everyone. And back to the beginning, I try and tell my founder clients that things are going to change and that this may happen. And to Ben's point, even if they have super voting Class F founder stock, that if they need money, the new investor can change everything, or whoever's needed. So I'm working on a transaction right now where, in fact, there's a great CEO who had a great idea and brought in investors, raised money, and the market has responded that that's not what they need. But they still have the elements of a great company. First founder has realized that his majority stake no longer makes sense, and he's even exited the business, and he's going to hold on to a much smaller stake. And the convertible note holders are going to agree to new stakes. And there is no formula or algorithm where it's fairly done according to their past contributions. It's not about the past. It's what's needed for the future. Ben, you were going to jump in there.
Well, just a couple of things on recapitalizations. I want to make sure everybody understands these are very traumatic things that you would prefer to avoid.
Yes,
these are not good. There's no let's do a nice healthy recap. No, recap is bad. As an example, there's a concept in investing called pay to play, where basically the new investor says, "Well, I'll put in money, but only if everybody else puts in money in a pro rata share." And that's usually in a company that's in trouble, and their answer is, hey, if you don't put in money, we wash you into common. So we take all your preferred shares, we reduce them 20-1, and we shove them into common, and basically you're screwed. So recaps aren't good, and you'd prefer to avoid them. Now, having said that, one of the things I tell entrepreneurs often is whenever I meet a team of three, there's this concept in the nature of the triangle theory. When you have three, two will gang up against one eventually. And it happens whether you have three kids or you have three co-founders or three anything.
Yeah.
And
Ben, I just want to say that three wives is particularly problematic.
That's got to, I've been really looking at how I can get that opportunity available. And apparently the laws have changed in Salt Lake City, so I don't think it's legal in the U.S. But since I'm not a royal from a family based on sand and oil, I don't think I have that chance. And I'm sure someone would say 3 husbands would be even worse. You know what I think guy is? Like, my wife is so gracious to put up with me. Like, oof, man. Okay, so to take off that tangent for a second, though, because I can go on tangents for a long time. When I see an entrepreneur that's in a set of three, what I will usually tell them is, I have never seen a team of three survive. I've funded a couple of teams of three. They're all teams of two now. I've funded teams of four that are still teams of four, and I've funded teams of two that are teams of two. But teams of three, like, yeah, somebody isn't going to make it. Now, you'll never know who. Just while you're friendly now, sit down and do the best you can at figuring out how to treat each other fairly when one of you has to leave. You won't get it perfect.
I'm going to disagree with you, Ben. I totally disagree with you. I think teams of three are better because it's inherently human nature that when you're outvoted, you accept the result. But when it's two founders and one has to impose on the other, the one who's imposed upon always thinks it's wrong and they've been wronged and they carry a grudge and it gets nasty. I disagree with you, but odd numbers are better.
I've had no teams of three survive as teams of three. So I'm only going on a finite data set, but okay, so I would take away the three or the two or the four. Let's apply my base rule here. While you're friends, figure out how to treat each other if one of you needs to leave. Now, you won't get it right, but you'll get it better than when you're furious at each other thinking the other person screwed you. So, like, begin with the end in mind. And unfortunately, one of those ends is assume, fatality, mortal combat. Like, okay, well, what's fair at that point?
I want to go back to a legal point, Ben, which is that there is a recap where everyone consents and everything moves around. And then what you've described is the cram down. The cram down is when somebody is forced against their will by having been converted into a lower class of stock that has lower voting rights, and new money comes in with superior rights and superior votes and flushes them out. That is the really unpleasant ending that is not consensual. Sorry, I wanted to make sure people understood the difference between the cram down and the happy recap.
So, guys, we've only got 5 or 6 minutes left. So, I think the advice that we've given the audience so far is, first of all, pay close attention to the cap table. Use a tool like Carta to create your cap table early to model different scenarios. Be aware as you're handing out equity, recruiting a team, handing out safes for some pre-seed financing or some seed financing. Make sure that all that gets entered onto the cap table. Make sure you're modeling everything correctly. We've also talked about vesting schedules and that you want to put everybody, including the co-founders, on a vesting schedule so that you have to stay with the company. The typical Silicon Valley vesting schedule is a 4-year vesting schedule with a 1-year cliff. That means you have to stay at the company for a full 4 years to get all of the stock. And if you leave in less than a year, you get nothing. What else? What else would you say? Andre, I'd love to bring you back into this. What else would you say?
I would say 2 other points. I think people always talk about, and I don't like to use this term because it's used very loosely, about smart money. I think there are certain investors that would come in and on the day-to-day, they will help the founder a lot. And then typically those tend to be very founder friendly, or the founder prefers those, or you hear in the market that those are very nice funds that they use to connections and whatnot. But sometimes when they're negotiating their deal terms, they're very, very, very harsh on the founders in terms of what they get. I'm not saying that's what Ben does, but because he's a very nice guy. But there are times where you talk to clients and they say, well, but they helped us with X, Y, and Z. But then when you look at the deal terms, they're very aggressive. So that's the one thing. And then the other note I would say is, if we have to wrap it up in terms of tips, is there are other types of ways that you can continue to fund your company as you grow, right, without giving that much equity. So again, not on the equity side. So venture debt is one way that you can go, and meaning you're getting a little bit of debt and you're giving a smaller piece of equity of your company to a lender that will be able to fund your capital. Again, not very early stage. Let's be very clear with everyone. You're not getting into venture debt on your first rounds. You need to have actually institutional investors with a lot of reputation, like Tenacity and other funds, in order for you to be able to get that product into your company and that funding. But look sometimes to other alternatives that you can do as you manage it. And the last one I'll say is, sometimes when you want to save a little bit money, and I'm not talking about only lawyers, I'm talking about advisors as well as consultants, get the right people on your side right away. because making that mistake early on is going to cost you way more in terms of capital, not only on fees and advisor capital, but also on your own time to clean that up. To Ben's point, a recap, it's not something that is like, oh, let's just do one. You flip your fingers and you're done. It takes a lot of your time. It takes a lot of disruption with certain of your early investors. It's not something that you want to do right.
Yeah.
I mean, hopefully you won't need it to do it at all in your company if you do things right.
Yeah, good advice. Louis, what else would you say to a startup founder today who wants to optimize their founder equity?
I try and have very sanguine discussions about, what are their priorities, what is their long-term vision of success, and not every founder wants to raise gobs of capital, and not every founder wants to take it all the way through IPO. Some of them are really just big ideas people that know they're 0 to 1, not 1 to 10 people, and they're going to be handing off, and so they want to take a stake that they're going to hold on to. And I like to really map out the future a little bit, Brett, and think about that. One point we haven't made is, what does when you are separating from a founder, what do you need? And again, to anticipate what a future investor is going to be worried about and whether there's a claim, you're going to want to have some sort of a separation and release agreement, even if it's a happy founder breakup. To make sure that there are no claims and no disparagement possible, and that the equity stakes are very, very clear. And so, I also like to tell founders that there's a happy exit and there's an unhappy exit. The happy exit means they can remain perhaps referred to as a co-founder. They can remain an advisor. They can have some equity incentive that continues to vest, and they can have some continuing role and benefit from the halo effect of whatever success the company has, and be a cheerleader. The unhappy founder who's being exited, likely is going to not have any of those roles, and is likely going to be prevented from talking about the company at all in exchange for whatever settlement that you're able to get. And so I think a happy breakup is better than an unhappy one in all things.
Yeah, it's a good point. I also want to just really quickly piggyback on something Andre said about other non-dilutive sources of financing. I think this is kind of worth noting that those of us in Silicon Valley, our muscle memory says that every financing involves selling equity, because that's the model that the venture capital business here has always been built upon. But today in 2022, there are a lot of different sources and structures of financing available to entrepreneurs. There's revenue share notes. There's a company called Clearco that will give you marketing dollars as long as you can prove to them that your customer acquisition cost is less than the lifetime value of a customer. They'll fund your marketing campaigns and take points on that. So there are non-dilutive sources of financing available today. It's just kind of worth pointing that out.
Best financing is revenue, Brett.
Best financing is revenue. That is 100% true. Building a company the old-fashioned way. Excellent point, Louis. So I think that will be our final word, that if you're really concerned about dilution, grow a company the old-fashioned way. Ben, do you want to get in a last word on this?
Well, unfortunately, I don't have just one. Some quick look, but I want to give a couple of tidbits. Yeah. One, I think in an effort to avoid recaps, one of the reasons people want recaps is that VCs get itchy when there's a lot of people in your cap table. They don't know who they are. They don't know if they're going to leak information. I think there's been a lot of evolution of the roll-up structure, where basically, think of it this way. If you're going to take small checks from small people, just create one line item for your cap table, my brand X roll-up entity, and they can put their money into that. They get the same stuff, but on a cap table, it's just one line, not 40 people. You could have 100 people in there, but then the VC doesn't get freaked out. Who are these 100 random people? It's just a line. Secondly, I would say, and push back on me if you guys disagree, that as I think a lot of times entrepreneurs just don't understand what's market. As a rule of thumb, if I'm going to create one, different than the Ben rule, I think on your seed round, your true seed round, you don't want to give up more than 20, 25%. Yep. Now, sometimes it can stretch to a third, but I think that's pushy. So think of it as 20, 25% of your seed round. A standard Series A, the new investor is going to want 20%. If they're tier one, good luck getting them to take less, and they might want to take more. But market is 20% for your Series A. Market is usually 20% for your Series B.
Right.
Then it gets less. Maybe it's 10% for your C, maybe even your D, maybe even less after that. So think 20, maybe 20, 20, 20, 10, 10, less. And then model that so you know where things are going to go, because the first round, do they have pro rata? If so, it's all going to add up. Like you're going to net. If you've got big dreams, you want to do an IPO, you should expect to own high single digits of your company. Whatever it was, Dropbox, he owns 7% of a $5 billion company. You can do the math. It's okay. $350 million. I'm probably pretty good with that. But understand that over time, it is going to be diluted down. And, understand, last point, when you take money and give up equity, that's your decision. Those are self-inflicted wounds. Okay. Do not complain to me later because you took so much money and took so much dilution. You now need me to re-up you at some massive level because you're feeling sad about how low on the cap table you are. These are your calls to make. So make them with open eyes, make them planned out over time, understand where you're going to end up in the end.
Very nice. Louis, thank you so much for putting this together today. You were the man who had the idea. You were the man who recruited the four of us together. And so thanks for doing this. It's been a great discussion, and look forward to the next one.
Thank you very much, everybody, for joining. And if any of their founders out there, reach out to anyone on the panel. All the best.
Right. You can find us all four of us. You can find us on LinkedIn. So reach out.
And if you want to pitch a business, pitch-ben.com. 1 minute video pitch from you gets a guaranteed 1 minute response from me. Pitch-ben.com. You can always find me there.
Perfect.
Awesome.
Thanks, everyone.
Rest of the weekend.